If you invest at all, even with a 401k, you've likely heard the phrase impact investing. Listeners of this show will pretty much likely have heard of it on many of our episodes, or maybe you heard about it in one form or another. But what is it exactly? Well, all impact investing is not created equal. And sometimes I think every investor has their own definition of it. Yet there are huge financial institutions that have what they call impact funds, but they're not the kind of funds you think about, I don't think. But what are they? So we'll find out, right? Can anyone participate in them? It's okay. Hold your questions. We'll get there. These are some of the questions we're going to seek answers to today from a woman who runs one of the most prestigious impact funds around. So let's get started. Welcome to Electric Ladies Podcast. We bring you insights and tips from remarkably innovative women about corporate responsibility, energy, sustainability, and ESG-related issues. I'm your host, Joan Michelson. We talk about innovation, leadership, technologies, and careers, always bringing a new perspective. We give career advice, by the way, in every episode, especially at the end, but it's often kind of sprinkled throughout the conversation if you pay attention. Find us anywhere you like to listen to podcasts on our website, electricladiespodcast.com, and through my Forbes blog as well. And please pass it on to your friends and leave us a 5-star review if you are so inclined. It helps other people find us. If you are struggling with your own career, especially in this craziness, please reach out to me on Twitter and let me know. We can help you no matter what industry you are in. So with so much discussion about the financial markets these days and about the climate and impact-related legislation passed last year, it's a good time to explore one of the ways to invest aligned with your values, known as impact funds. We want our money to make a difference in a good way. And we want to earn a great return on it too. So you may have heard the term from someone you know who invests in early stage companies or in the context of venture capital or from an investment advisor or frankly, even a commercial. But the terminology can be very confusing because the word fund is used in many different ways. There are funds that invest in stocks and bonds. There are funds that invest in companies. So let's find out what an impact fund is from a woman who is at the top of the field. I'd like you to meet Meredith Shields. She is head of the Citi Impact Fund. It's a fund that's now, I think, at about $500 million. We'll find out, which invests in what they perceive as, quote, game-changing early-stage companies that are driving access and inclusion. What does that mean? We'll find out. They focus on startups addressing climate change, as well as other fields such as workforce, housing, education, healthcare, and financial services. Before coming to Citi, Meredith managed the early stage investment portfolio for the Sorensen Impact Foundation, which has a similar focus. And before that, she was a fellow for the Beyond Capital Fund in Zurich, Switzerland. And I'm totally envious because I love Switzerland, where she did the same work. But that was focused on companies in East Africa and India, which is really cool. I've been to East Africa. She also spent about 10 years in strategy consulting and banking in the U.S., and I could go on. But anyway, Meredith earned her MBA from the Kellogg School of Management in Northwestern University and her undergraduate degree from the University of Virginia's McIntire School of Commerce here where I live in Virginia. So without further ado, please join me in welcoming Meredith Shields. Welcome to Electric Ladies Podcast, Meredith. Thank you for joining us.
Thank you for having me, Joan. I've been looking forward to this.
Oh, yeah. Me too. So let's start at the beginning so we don't lose anybody. We hear about all kinds of funds these days. So let's define some terms. What you're talking about here is not a fund that your 401k would be in, like stocks and bonds. You're talking about a fund that invests in early stage companies, right? So tell us what the Citi Impact Fund actually does and how it works.
Yep. No, sure. And thank you for clarifying. I liked your opening where you talked about how there are so many different types of funds and we all use that terminology to mean different things and it's very confusing. So the Citi Impact Fund The type of fund that we're talking about is the same thing that people mean when they say a venture capital fund or a private equity fund. So we have an allocated pool of capital that we are investing in early stage startups that are solving some of the world's most critical challenges. And the way that we think about those investments that's different than traditional venture capital or private equity is that we care just as much about the financial success of the company as we do the impact that that company is going to make on the world. When I say impact, I'm sure we'll get to this, but we think about that in two parts. One, who is running this company? And can we deploy more capital into diverse founders, meaning women, people of color, who have traditionally not received the investment capital that's warranted? And the other impact lens that we take is what we would define as thematic impact, which means what social problems are we solving? Is it access to healthcare? Is it access to education? Is it access to climate resilience strategies and solutions? Those are all the types of impacts that we want to have. And again, we care about that just as much, if not more, than the financial return.
Thank you for that. I appreciate that. So would you say that that's the same as what's often called ESG investing, for environment, social, and governance investing, or is there a difference? Well, if there is, what would that difference be?
So when I think about investing, there are two sides. There's public investing strategies. So the funds and investors who would invest in a public company like Citi or in a mutual fund. And then there's private capital. And in my mind, that's things like what we're doing. So investing directly into a startup company that is nowhere near a public company. In my world, in the world that I've been in for the last 10 years or so, often when people talk about impact investing or impact venture, that's synonymous with the private capital side of the equation. So the investing in new businesses that are going to come in and change the world. ESG investing, I typically hear described more on the public side of investing in funds that are investing in a number of public companies that do good things in the world, and screening out companies that are not doing good things to the world. So that's my definition. But there's a lot of debate about how those terms are used.
That's okay. What I wanted was your definition, so that's perfect. So I saw on the Citi Impact Fund website, that the fund has invested $125 million so far. Maybe that's changed since the website was last updated, but in 39 companies and other funds, which is just to make sure we're really confused. So what do you look for in companies that you're considering investing in? I mean, you kind of gave us a little bit of a sense, but maybe are you looking for companies that have revenue making solar panels kind of thing? I mean, there's stage, there's found, I mean, you've got your criteria, right? So what would be the criteria for companies that you would even consider reviewing as an investment?
Yep. So I'll give you a couple dimensions. I'm going to start with impact. So we are looking for companies that one of our qualifiers is reach. So we're deploying what we would describe as venture capital for a reason, and that's because venture capital investments are designed to create scale. We want these companies to grow and not only generate, again, business returns, but to generate impact at scale, to change industries, to change the way that things work. So reach and scale potential is a big part of our analysis. And we dig into the business model, we dig into the market, we try to understand what what can work and what can grow and succeed. And importantly, and we'll get to this later, what role can Citi play in helping that happen? Another dimension that we look at is access, and who is this solution serving? So the terminology I like to use is who is the solution or the company optimized for? And in our case, the group that the solution needs to be optimized for is underserved communities. And we can define underserved communities in different ways depending upon what the industry is or what company we're looking at. But generally, underserved communities are lower income communities, people who are disabled, underrepresented, generally are disproportionately negatively impacted by a lack of equity and inclusion in society. So access is a big dimension for us. We also look at value add. So we'll talk a little bit about how the Citi Impact Fund was launched in a bit, but when we look at our reason to exist in this ecosystem, a lot of it has to do with the fact that we are part of this premier financial institution that operates in 95 markets, has incredible reach and breadth. And so for every investment we make, we want to bring what we have, the resources and access that we have to bear to help the entrepreneurs and solutions to grow even faster. And so we do look at that potential on the front end. And then, finally, I would just say similar to the way that many investors look at an investment, we're spending a lot of time with the management team, with the founders. We want to know that the mission is at the forefront. We want to know that the impact is something that they really care about and that we can support them in that. Again, and I think the founders that work with us would say that we're also extraordinarily diligent. We ask them every question that can be asked, but of course, the things that I just laid out, those are our big focus areas.
Oh, that's really helpful. What about stage? So, I mean, as you well know, there are many stages of a startup, right? There's companies that have an idea, they're building a prototype, but they have huge potential. There's companies that have some technology, maybe even some patents, maybe got some grants, but they need money, whatever. And then there's companies that are making $1 million or something, and then are ready to elevate, or poised for scale with the right team and the right investment. So where on that spectrum, thank you, I couldn't think of the word, where on that spectrum do you guys fit, or maybe all of them?
Yeah, it's a great question, and it's one that we've thought about in a lot of different ways. Right now, we are focused on Series A through Series C, which many would describe as the valley of death for entrepreneurs. There are a number of different mechanisms for seed and angel investing. Once you get to the A, B, C, your potential capital sources get smaller and smaller and smaller, and this continues as you grow. Where we can align what Citi has to offer in supporting early stage companies and the type of capital that we have is really in that Series A to C. So that's how we think about the stage. And what that looks like in reality is it's not the companies that are just at the idea stage. That's what I was doing earlier in my career. It's the companies that have gotten past that first idea. They have some proof of concept, like they have some customers, somebody's paying for their service or paying for their thing. And they have some demonstration of what we often call product market fit. So we can see evidence that the market likes what they have to offer, and the window's starting to open, that change might actually happen, and this company might be able to be the one to do it. There's a lot to go from there to actually making it happen. And so we think that early, foot in the door area of a company's growth is the perfect place for us to come in and partner with them.
Oh, I love that. And just to clarify, are these just US companies or are these global?
Just US.
Just US. Okay, cool. Well, what's interesting to me is I know so many companies. I shouldn't put it this way. What I see a lot is I see a lot of investors wanting to do Series A investing, and I don't see as many on the other side, which is kind of interesting, but we can talk about that as well. Can you give us some examples maybe of some of the companies that you've invested in, particularly in the climate sustainability, clean energy-ish space?
Sure. Before I talk about climate, because I am a mom, I'm going to start with one of the childcare desert focused companies that we've invested
Oh God, do we need that? Go for it, girl.
I know, right? I love talking about this company. We invested in a company called Wonder School, and they recognized that there is a dearth of access to childcare all across this country. And we don't even need to get into the fact that the cost of childcare outpaces the cost of college in over half the states in the US. I mean, it's wild, right? So this company did something that we think is really innovative. They figured out a way to empower individuals to create home-based childcare solutions. And they've been very successful. They're in a number of different markets. And one thing that we're proud of is that if you're launching a childcare center in your home, it's important that you have a clear understanding of the mortgage products on the market and things like that. And so our team at Citi, our Citi mortgage team and community relations, has worked with a number of groups across the Wonder School ecosystem, trying to add some value there. But we're really excited because for us, Wonder School it's one of those companies that's addressing a systems level problem that ripples through. And I'm going to say, especially for women. So a lack of access to childcare, we saw it during the pandemic. It causes lots of challenges to children, to families, men, women, companies alike. And so that's an example of a company we're really excited about.
Oh, I love that. It's an economic issue. That's why I get so damn angry at some of these pompous white guys who say, well, we don't need to worry about childcare. We need to worry about the economy. And it's like, have you talked to your wife lately? It's like,
well, it's hand in hand. You can't go to work if, you don't have a safe and nurturing environment
exactly.
for children.
One quick question about that, though, before you give us other examples. What comes to my mind is zoning and licensing. I mean, don't these does and I love the name, by the way, Wonder School, because I'm a wonderment freak. But do they have to have their home? I mean, it has to be licensed. It has to go through all of that, and I would imagine that there's some residential areas that have some kind of issues with zoning for different kinds of businesses and stuff. So is that one of the things that Citi maybe can help them with because of your depth of expertise in mortgages and stuff?
So I'd say the Wonder School, like what you're highlighting here, is that creating a childcare center, whether it's in your home or anywhere else, is really complex. It's heavily regulated. It's expensive. It requires a lot of resources and hiring. It requires reporting capabilities, so you have to really be tracking things. And that's what Wonder School does. They help educators and caregivers to they provide them with the resources to be able to do that. So absolutely helping them to think through. I don't want to say it's an in-a-box solution, but their goal is to make it easier to get over that frontier.
I love that. Okay, now let's give us some climate examples.
Yeah. So, okay, this is another company I just love. They're based out of Chicago, which is a former home of mine as well. So that is part of it. But this company is called Reaply. So they're founded by a gentleman named Gary Cooper. And their aha moment was that, like, let's say Citi is transitioning an office space or moving to another building. What happens to all of that stuff? The desks, the chairs, the kitchen equipment, I mean, all of these things. There's not a great way to trade things around, because it could be the case that another location at Citi needs 5 chairs, and we are trying to figure out a home for 5 chairs. It's a market that's not a closed loop, and so Reaply has come up with a solution to help create a circular economy for items like that. And they're have a really innovative idea, and their whole goal is, let's reduce the waste and the landfill space that's taken up when things are inevitably discarded, and let's reuse things.
I think that's great. I have had a client that's an environmental consulting firm, and their rule was every time they furnished any offices, they had to get recycled. They had to get furniture from like a thrift store or
Okay.
somewhere. They were never allowed to buy new furniture.
Hmm.
And if they had to build any kind of dividers or anything, they had to use recycled materials to do it.
That's incredible. I mean, imagine, it's one of those things where it could be a fairly small change, at least here, where we do have a lot of goods in the market. A fairly small change that could ripple through and have a fairly enormous impact, for sure.
Oh, absolutely. And I bet their Ripley's business is, if not booming now, about to boom with all the offices closing around the whole country because of COVID reconfiguration of real estate and everybody working mostly at home. Or certainly the executives I've talked to have said, oh, we're not having anywhere near the real estate footprint we had before.
Yeah. Yeah.
Yes. Okay, give us one more that's maybe anything sort of technical or technology, any kind of.
Yeah. So we have another company that we've invested in is called Om Connect. Have you
Oh,
heard of them by any chance?
no, but
Um,
I'm a yogi person, so I like that.
Okay, I see the connection. So their goal is to take pressure off of the grid by empowering individuals to opt into a lower usage time. So if I am an Home Connect user, in California, I can get a notification that says, okay, are you prepared to do downtime from this time to this time? In 2 hours. And conceivably, I'm at work or I'm in New York or something. And so my answer is yes. And so they can help manage pressure on the grid by, at the same time, reducing consumers' electrical and utility usage. So it's also an innovation that, in my mind, is one of those like two-sided wins. So it has an affordability play, which is excellent, and then it also has an environmental sustainability play.
Oh, I love that. So you mentioned women-owned businesses, and one of my frustrations, since we're talking about companies to invest in and diverse founders, is that women founded companies get a pathetically minuscule amount of venture capital. Last year, they got, brace yourself, 1.9% of venture capital. And that's unfortunately not an anomaly. I mean, the record was 2.8%, which I think was 2019. And I'm going to try not to have steam coming out of my ears as I give these numbers. And then again, VentureBeat reported a first round capital study that female-led startups actually generate 63% more value for investors than male-led startups. The Kaufman Foundation found that women-led teams generate a 35% higher return on investment than all male teams, and that women-led businesses are 63% less likely than male-led businesses to receive venture capital funding. I mean, what the bleep?
So here's what I think here's what I think about this. And I'm only laughing because you can only laugh or cry.
I know,
But
it's
it
true.
is so Joan, I'm glad you brought it up. It's I think on my epitaph it will say she really cared about access to capital. 'Cause it's it's what I've been doing for a long time. And I care deeply about this. And in my mind, it is a systemic issue that we can change with some process and some new ideas. And so when you think about the venture, private equity, the private capital markets in general, they're very, very relationship based. They're very network based. They're taking an exorbitant amount of risk, usually.
Yeah.
And when you pair those things, a lot of risk and uncertainty, and a high propensity for the industry to run on relationships and network, you're dealing in trust. And trust is something that is highly has a high potential for bias. We know this. And in my mind, that's how we got here. That's part of how we got here. That's why, historically, there just haven't been as many women at the top directing traffic and asset allocation. Same is true with racial minorities in the U.S. And now that we know this to be true, we can be taking steps to avoid the bias that we know is rampant. So I want to give you a quick example because I'm really proud of what our team has done here. Citi, as part of many initiatives across the organization, including for our Action for Racial Equity, launched in 2020, embraced this notion that we can make change happen by recognizing how we got to this place and then rethinking the future. And so the way that the Impact Fund is doing that is by over the last 18 months, this has been a long running project, we have looked at every step of our investment process and identified where can the bias come in. So simple things like it's very common in I'm going to speak outside of Citi, in other places that I've worked, but very normal in the financial investment industry, to introduce a founder by talking about where they went to school and how you know them. And that might seem like on the surface, like a very normal interaction. What it does, though, it introduces bias from the onset. We haven't even talked about what the company does. So things like that we are removing from our investment process and being thoughtful about. We're also tracking metrics really closely. We're looking at, how are we doing when, this many women come in? Is that how many? Is it proportionate? The types of women-led investments that we're investing in. And importantly, we're also trying to enhance the pipeline. So another thing that I know you and I have talked about before is that I've heard investors say, well, I can't invest in women and people of color because there isn't enough pipeline. And I think many would say it's not that there isn't enough pipeline, it's that it's not in your pipeline. And so you need to go out with some intentionality, and look for diversity outside of your network, especially if you don't have a very diverse team. And so that's something that we have done with a lot of intentionality. We've built networks with different accelerator type organizations. You mentioned that we do invest in a very limited capacity in other funds. We intentionally invest in earlier diverse investing funds as part of that pipeline and network development, to bring diversity into our pipeline. And those are just some of the things one thing that I think our team identified early on is that there's no silver bullet to a solution here. It's an evolution, and it's a willingness to continue to evaluate and try new things. And that's where we are. So today, over 70% of our companies are led by women and people of color, which we're very proud of. Those numbers are quite a bit higher than the traditional investing sector, as you pointed out. And we expect that to just increase. The 3 deals that we have closed, in fact, I think every deal we've closed this year has been led by a woman or a person of color. So as our pipeline grows, we expect to continue there too. But I'm with you. It's something we've got to fix.
Yeah, I'm so glad you went through all those details, and it's fascinating that the introduction of the founder is a place of bias. What comes to my mind is that maybe we need to look at the criteria for what to invest in, because I think that women-led companies, first of all, women tend to understate their accomplishments and understate the potential of a company and not seek enough money and from their angel investors, et cetera. I mean, there's always this kind of under everything, right? When you're doing it, under estimating, under seeing less than you can be, right?
Mm.
And and so I wonder if maybe going earlier in the continuum. I love that you're in those funds to get into the pipeline of the companies that might, when they're ready, you can be there. I mean, I know some other big company venture funds that take a seat on certain companies' boards so that they can be there when that company is ready for their capital, and get to know them a bit. But I almost wonder if maybe the lever on the continuum, on the spectrum of where you invest, maybe needs to move a little more towards seed or something like that, because a lot of the women that I talk to, and I've now aired my 400th episode, which is kind of mind-boggling, have they don't see themselves as a necessarily, it's like, it's almost the messaging. It's like seeing themselves as a Series A company, they can't get their brain around. And so they tend to maybe see themselves as as looking for seed funding. It's like it's a mental block almost.
Interesting.
So I'm just wondering if the continuum to be earlier, and maybe if even put in less money at the earlier stage, but then at least you have an opportunity to help expand it.
Right. And, we've done some seed investing, where we get to often, and a number of our really high performing companies that are actually working with Citi to explore like real big partnership, are led by women, which we love. Um, it at when I go back to thinking about the different investors in the impact space, or we could even just say in investing at all, I do think it's really important to be mindful about what you bring to the table, because ideally an investor is not just writing a check. I mean, that there are a lot of organizations that can do that. What an early stage founder needs at every level is support, is someone in their corner. Is some level of mentoring, network building, exposure, amplification. I mean, all of these things, right? And so for us, when we think about what we can do, we can really move the needle for a company that's ready for Citi's.
Oh yeah, the impromptu of Citi just can move mountains, I'm sure.
Yeah, I mean, truly, I've been here for 18 months, and I continue to be amazed at just um, how impressive this organization is. But I say that because that we like to be very supportive to the ecosystem. Like I said, we've invested in some seed funds um, that do some of the earlier work, but we really truly believe that for right now, our value and where we can really accelerate and get companies to the next level is just in that right past seed level. But it's an interesting thing that you point out about the continuum and maybe the way that companies would identify, for sure.
Yeah, and we can talk more about that offline if you're interested. But one of the things that's coming up now is the SEC climate risk disclosure rules obviously are coming down the pike. And I know that they had 14,000, maybe 15,000 comments. Maybe you guys submitted some to the proposed rules last year, but they're getting ready to launch the final ones. And I'm wondering, I mean, any input that you guys would have into those, I'm sure would be incredibly useful. But what impact do you think those rules will have on what you do and impact investing in general?
So I'll be very transparent that I am just not the expert here. We have
It's okay. I'm not expecting you to be an expert. I'm just curious what you think.
Well, it's one of those grain of salt things. I think Citi's sustainability and ESG teams would be very prepared with a better answer. I'll say for the impact investing space in general, and I had a conversation with some ecosystem builders on this last week. It appears that this movement to care about the impact of where your money is going, in addition to what comes back to you, has moved. It is not just a handful of family offices and foundations that care about this and are trying to get everyone in there. I've done that work. That's been the chunk of my time in the impact investing space. But somewhere around 2017, when the Ford Foundation announced that they would be putting part of their endowment in impact investments. And then there was this ripple effect, and lots like institutional big funds came out with impact funds. Something changed, and now more recently, we're seeing even more corporates very focused on this. We're seeing big companies demanding more of their suppliers. Their customers are demanding more of them. This movement appears to have grown and expanded. And so all I'll say that is that I'm very interested to see how this plays out and the impact that it has on our industry. But I do think that it feels natural to me that there's an expansion of the formality of the impact sector as it has grown, and is I dare I say, no longer niche.
Yeah. Yeah, and I appreciate the way you put that expansion of the formality of it, because I think that it's going to have a profound impact for two reasons. One is because it's the SEC, there's that, right, as you say, the formality, right? But also because you have to have, so that's a Rubicon that's crossed. That's a big, I mean, it's no longer, oh yeah, fine. I mean, you can't do greenwashing anymore because you have to give verified data to the SEC. You can't just say, oh, okay, let's figure out, and pick a number, right? You actually have to be able to trace it and track it and prove it and verify it, have it third party verified. Independently. And so I think that will have a big impact. And I also think that because it has to ripple through the whole supply chain, that's going to have a huge impact as well. I interviewed the former finance minister of Ukraine. And one of the things that I ended up coming up with, to be honest with you, as a result of the discussion and her talking about how the impact on their world, what the impact on their world would be, is that this reporting may even help disclose dark money because it has to go so deep into the supply chain, which could be, of course, enormous, but that's a whole nother topic we can talk about. I want to ask you two other things, and then I'll get some career advice from you and let you get back to your day. But one other bugaboo of mine, by the way, what is the average age of the founders that you invest in? You being Citi impact funds.
Great question, Joan. I do not know.
Okay. So one of my bugaboos is that people always talk about young founders, but the data and lean towards young founders. Yes, young, white, male, hoodie founders to be specific. But anyway, but the data is actually the opposite. The Census Bureau and the MIT did a huge study and found that 50-year-old startup founders are over 2 times more likely to found a successful startup than a 30-year-old. And even a 60-year-old startup founder, get this, is 3 times as likely to found a successful startup as a 30-year-old, and almost twice as likely to found a startup that winds up as a unicorn, one less than one of the top 1% or 0.1% of companies. And that makes sense to me because people over a certain age bring experience, they bring networks, they bring, all the stuff you're talking about that they need, right? They have more, they've been around the block, they have a better sense of what may or may not work, right? So how do we avoid some of the ageism too in choosing who to invest in?
It's such an interesting topic because they'll say, from my perspective, we when we think about a founder's experience, we try to be very open-minded, and here's why. In my world, at least, I've seen somewhat of a natural bias toward more established founders. We have a number of companies that come in to pitch to us, and it's like their 4th run at this. They have a couple unicorns. They've IPO'd a few times. And that is very appealing. And you could imagine that people are sort of racing towards those founders. I would say the same is true with a really amazing operator. So a number of former executives at big companies who decide to peel off, and we're in the process of making an investment right now in a company that has that type of management team. And when you look at the depth of experience and measure that against, hey, we're trying to make scaled change. We're investing to change industries. And who better to change the industry than someone who ran one of the big guys? That comes up for us a lot. And so I only say we have to challenge ourselves there, because we don't want to only invest in companies that have that dynamic, because there are some new innovators who can look at something from the outside and say, that's not working, I have another way. Yeah. And we want to give them a chance as well. But yeah, I don't even want to guess what the average age is of our founders, but for us, I don't think it's as young as maybe some of the organizations that you're benchmarking.
Oh, that's interesting. And having spent many years in corporate America, and Steve Blank, one of the fathers of venture capital, if you will, and a startup master, talks about this a bit. But a lot of times corporate people who spent decades in the corporate environment, like a recently retired somebody who'd been there for 35 years, might actually be the wrong person because they are too steeped in the way things went before. Like when I was recruited by Chrysler to head up communications and co-head the sales and marketing of their electric car division, they told me that I was recruited, that they wanted me to come. I just met the president of the company without knowing who I was talking to actually at the moment. And I had a bunch of ideas, and he said, the reason that you've been able to do hockey stick growth is because you didn't come in with the way things have always been done. You just automatically had all these new ideas. But the flip side is, if they had posted a job and I had applied, they wouldn't know my name because I would have been screened out by the system.
Interesting.
So it's kind of an interesting thing to talk about. So one other thing, and I apologize for keeping you, but I really want your thoughts on this, and that is the board of directors of the future.
Hmm.
So you've seen the markets go up and down. You've invested in all different kinds of companies. You're at a big public company now. You're dealing with creating new boards maybe for some of these startups. So if you could wave a magic wand and create a board of directors of the future without having to just tweak what we have, but just kind of from scratch, what would it be? What would they do? How would they function?
I'm going to hit on a point that that comes up a lot for us. So with younger companies, oftentimes the board of directors tends to be comprised of investors and current management or the founder. Um, we've been very vocal with our portfolio companies, and we track this data around board diversity. Because as you've pointed out, more diverse teams lead to better results, period. I mean, even in the example that you just gave around, you need people with new ideas who aren't so entrenched. And so in my view, having a board that has a nice balance of people who are closer to the day to day, but also people who can introduce and challenge current assumptions is very important. There's always a need for subject matter experts, especially on earlier, younger boards. I've seen the SMEs in a boardroom really make incredible things happen for a company. From, again, as we talked about earlier, young companies need advisory. They need a network and people behind them, and that's the way that the board should be set up to help a company to be successful.
Yeah, sometimes they even just need affirmation that they're on the right track, right? And to have somebody backing them up.
Yeah, it should be a partnership for sure.
Yeah, totally a partnership. So before I let you go, I like to give career advice to mid-career women, women who have at least 10, maybe even 15 years of experience, who have an education. They know what they're good at. They want to advance. They want to make money, and they want to make a difference. So what advice would you give to them?
Mm. So here's what I think. And I'm someone who's pivoted a couple
That's also why I wanted to talk to you about it. Go ahead.
times. Yeah. I I started off on the maybe at least traditional for when I graduated from college track of banking and business school and consulting, and did a big pivot to entrepreneurship, and then impact investing, and then all different stages of impact investing, and so kind of different things in between. And so my advice is to get really clear about what you're good at, what your functional skill set is, and what your managerial and or leadership skill set is. And then if you want to make a difference, think about where that's needed. So I will never forget this conversation because it set my career on a different trajectory. I was graduating from business school, and this was back when the term impact investing wasn't really a term. It was like, I think we actually did have this new seminar on impact investing, but it was just early days. And I wanted to go into that like sphere of merging capital and social progress. And I was having trouble finding what that was. Like, is that going to a foundation? But then, what job would make sense for me? There were no real funds really that were doing that at the time, so that wasn't an option. There were some bank type roles, and a woman at the MacArthur Foundation sat down with me graciously and said, "You know, you have a great finance skill set. I really think you just need to figure out how to deepen that. And then if you want to make a difference, go work for a company where you can do that, but in a good way. And at the time, I envisioned, okay, well, she means like go work for a nonprofit. As the world has changed, and as this notion of impact has changed, there've become more opportunities to use my skill set in different ways, like many different ways that didn't exist previously. But I think you have to be open to that as a concept, and so just again getting really clear on what are you good at and is that portable, can it, and many things are in lots of different arenas.
Oh, I love that. The way that I describe it with my career coaching clients is we're a puzzle and we're a jigsaw puzzle. And right now we look like this. But if we take the pieces apart, we can make it look like this or like this or like, I mean, we can make a different picture, right? Just by using your skill. I mean, if somebody had said to me 20 years ago that I would have been in the car business, I would have looked at them like they had 10 heads, So, and that it would catapult me into the green economy. It's like I would go, well, what the heck is that, right? So it's just illustrating. I mean, I'm sort of the poster child for your point too, and I love that. It's interesting how these, what I call mini mentoring moments, really can change our lives, right? And I bet you deliver many of them to your entrepreneurs too.
We try.
Yes. So, any final thoughts before I let you get back to your life?
No, I just want to say thank you. Thanks for the opportunity. I mean, we're trying to pioneer and amplify a more thoughtful way of investing. And so I'm grateful for the opportunity to come talk about it.
Oh, you're welcome. You're welcome. Well, thank you for joining us. Thank you for joining us today on Electric Ladies Podcast, Meredith Shields of Citi Impact Fund. So what does impact investing mean to you? Post it to us on Twitter at Joan Michelson. Send us any questions there for Meredith as well. And you may win a complimentary 30-minute coaching session with me. And please subscribe to our mailing list to stay abreast of our talented, amazing guests like Meredith, our articles, and career advice. And you can subscribe on our website, electricladiespodcast.com. I'm Joan Michelson. Thank you for joining us. See you next time.